But look, the bottom line is that all signs are pointing to the fact that we're probably headed towards a recession, if not already in one. Hello friends, welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm rolling solo, and I just want to touch on a few different things. I want to give an update on what's going on with interest rates because it's been an interesting couple weeks, and it's actually some good news. And the other thing I'm going to talk about here on this podcast is home equity lines of credit. I've seen a lot of different discussion about this, and I've been asked about it actually by a couple friends, family, and some past clients of mine. So I'm going to just touch on home equity lines of credit. Is it a good idea? How do they work? And what are the alternatives that you might also want to consider if you're looking to tap into your equity during this time where rates are a bit higher than what we are accustomed to. Now, look, as we move forward, I got a couple future episodes I'm really excited about. We're going to have some guests on here, and we're going to talk about reverse mortgages. I'm going to have an interview with a gentleman who all he does is convert detached ADUs, auxiliary dwelling units. This is a big topic. So look, if you're not already subscribed to Market Shares, go ahead and hit the subscribe button now so that you are notified right away when these next episodes drop. As you know, we drop every Friday at 10 a.m. Pacific time. So you don't want to miss an episode. We got some really good stuff coming for you in the near future. But let's talk about interest rates right now because it's kind of been the hot topic over the last week or so. And we finally got a really good rally with interest rates. Bond market made some big moves over the last week and a half, 2 weeks. And as a result, we've seen some pretty significant improvement in 30-year fixed interest rates. Now, there is some interesting news going on behind the scenes. And our good friends, I say that jokingly, but the big money out there, the hedge funds, have had a little bit to do with some of this market movement. And I'm not going to go into all the details, and quite frankly, some of it I don't even understand. But what I do know is the SEC is looking into some of the practices, and I know that the hedge funds out there had one of the largest short positions ever, and a lot of it was on leverage, shorting the treasury market. And as a result, that did drive down the prices and, it drove up the prices and drove down the yields. And then all of those positions had to be, covered as we got to the end of October. So, how that plays out for us in the long run, it's unfortunate to think there's enough pressures on interest rates already, right? So many factors impact what the pricing is of mortgage-backed securities and the treasury market and just the bond market as a whole. And then to think that there is these large money managers behind the scenes that are also causing some potential fluctuations in the market, kind of making the market, if you will. It's a little bit concerning, to be quite honest with you. So we'll see how all this plays out. But look, the bottom line is that all signs are pointing to the fact that we're probably headed towards a recession, if not already in one. And the first thing that I want to point to that I think is really going to be an indicator of this is what's going on with employment. And a big part of the rally that we just saw with mortgage rates is because we finally got what I would call a good employment report. Good meaning some increase in unemployment, right? Not as many jobs created. And I know that sounds counterintuitive, but unfortunately, those of us in the mortgage market, the ones that want to see lower interest rates, unfortunately, we have to kind of hope for some bad economic reports every now and again. And we've been waiting for the weakness in the job market to start to show up because we know that's the number one thing that the Fed has said. And, besides inflation coming down, employment needs to start showing signs of weakness. And I think we're finally starting to see this. So I'm going to throw a chart up here, and what you're going to see is that every single time, like 100% of the time in recent history, that unemployment has reached its lowest level and then started to peak back up, we've gone into a recession. Matter of fact, almost every time we were already in a recession, and this just kind of, solidified it. So this chart I actually stole from social media. This one was posted by my friend Josh Metal, but I've seen this same report in a number of different things. Dan Rawich has talked about it. I've mentioned Dan before. I get his newsletter every Sunday. Barry Habib has talked about this as well. And Josh did a great job of highlighting and circling all of those low spots. But as you can see, you guys, 100% of the time, what happens is when unemployment reaches its lowest peak and then starts to turn up, which is exactly what we're seeing, 100% of the time, that has meant that we went into a recession. Now, also on this chart, what you can see is how much interest rates typically drop during a recession. And every single time, they absolutely have dropped. The least amount that they dropped was about, 1% in rate, but sometimes as much as 5% in rate. So, look, if what you're concerned about is mortgage interest rates, and that is, if you're watching this podcast, you're probably in the real estate or mortgage industry, or you're considering purchasing a home. And look, this is good news on that front. Now, look, a recession, it's kind of a scary word, right? People don't like the word recession. And it is representative of a tightening in, the economy. And look, the feds have been pushing for that, right? That's why they have raised rates so many times to slow down the economy. We're starting to see those things take effect. Now, the question is how deep of a recession do we go into? How long does it last? And what are the implications of that? I will tell you, historically, the housing market fares very well in a recession, and a lot of that's driven by the fact that mortgage interest rates come down. And look, we know that there is nothing in the short term that's going to solve the challenges we have with lack of housing for people. So look, a small tick down in interest rates, in my opinion, probably fuels the energy in the housing market. We see more activity. We may even see prices increase, despite what you might hear all over the place, that home values are going to crash and crash significantly. I think there's a lot of clickbait out there. And look, there's definitely a softening in real estate as we speak. Like right now, there's a softening, just like the one that we saw in April, May, June of 2022, a little bit of a softening. But that was little and short-lived, and I think that's what we're experiencing right now. So anyways, that's my forecast, if you will, or outlook on interest rates. I'm not going to make a firm prediction today on what I think rates are going to do, because I don't know. But I do feel like we've seen the highest of rates that we're going to. Look, we're going to see some up and down, right, in the market, and we're seeing that even as I record this podcast. Last week, we had a really great improvement in mortgage rates, and we're given a little bit of that back here as this week starts off. But we're really just kind of trading sideways, if I'm being honest with you. We're still holding on to most of that improvement, and that's a very good sign. So we'll continue to update you here on Market Shares about what's going on with interest rates, because it really is a hot topic and something that's making affordability very challenging in this market. So we'll keep an eye on interest rates and let you know more details as that comes out. But kind of interesting on those unemployment numbers and how 100% of the time, it triggers or shows that we're in a recession. There's not many economic indicators like that you could point to that are accurate 100% of the time. So, we'll see if this one holds true, but it sure looks like it very well may. Now, I want to talk a little bit about home equity lines of credit, HELOCs. So I've been asked about this a number of times, and even my friend Anton, who you guys have seen on this podcast, if you're a regular subscriber, he put out a video the other day and it said, it's the worst time ever to get a HELOC. And I was like, what? I got to listen to what he has to say about that. And I'm going to give you Anton's logic here in just a second. But look, I think that this is something that some people are strongly considering. And I think you need to understand some of the pros and cons of doing a home equity line of credit versus some of the other options. So first, I'm going to start with Anton's comments. And I don't know if Anton's watching this, but I did watch his video clip. And what he was saying, and this is really smart advice, which is why I'm leading with this, which is, look, if you're in a bad financial situation because of your spending habits, right? Maybe your income's down a little bit because maybe you work in mortgage and real estate, right? And as a result, it's been a tough year. So maybe people are looking to tap into their equity instead of making changes to the way that they budget their money, right? This is not a time to pull money out of your home and use it to maintain a lifestyle that maybe you can no longer afford because the market conditions are not allowing you to do that. Obviously, the first thing that you should look to do is to change your spending habits, write a budget. If you haven't written a budget, get on top of that, know how much money you have coming in, know where it needs to go. Now, maybe a home equity line of credit could help you strategically pay off certain bills that are going to give you a sustainable budget that you can live with given your current income or whatever life situations may be impacting your ability to make ends meet. But pulling equity out of your home just to spend it frivolously is definitely a bad idea. And in a market like this, unfortunately, people tend to do that. So if that's your situation, I would think very long and hard about fleecing your home's equity just to maintain a lifestyle that is just going to run through your home equity, and you're going to be back in the same situation with no reserve to even tap into. So take real inventory of your spending habits. If you're not making ends meet, just pulling equity out of your home is probably not the best solution. Now, why would you want to pull equity out of your home? Well, like I said, you might be able to strategically pay off some very high interest debt that you have that you're not able to get ahead of and lower your overall monthly budget. Now, the fear here is if you did not have the discipline to not get into debt in the first place, chances are, for most people, you pay off that debt and you're going to run it right back up. I would challenge you that if you're going to do a debt consolidation and use your equity to execute that you really need to make a firm commitment to yourself and to your budget that you are going to change your spending habits as a result of paying off your debt. And I can speak to this personally. When I was in my early 20s, I've talked about this on the podcast, man, I was living large, even though my paychecks weren't large. And I used a lot of credit cards, and it's embarrassing to admit it, but I did. And I had myself in a good bit of debt. And I got into a situation where I bought a home in my early 20s, and I was able to consolidate all my debt together and paid off all my credit cards. And it was the most amazing thing. And you know what? Since that day, when I was like 23 years old, I have never maintained a credit card debt since then. It changed the way that my behavior was moving forward. And that's not always the case. And I'm lucky, but I made a commitment. I was never going to feel that way again. And I look back and say, thank God I own that home. Thank God I had the ability to leverage that equity, clean the slate, and change my habits moving forward. Not everyone can do that, but that's the discipline you have to have, in my opinion, if you're going to tap into your home equity through any means and use it as a debt consolidation tool. So take that for what it is. But let's talk about what is a home equity line of credit, because I think a lot of people don't fully understand this. And I don't know of any home equity lines of credit that are not adjustable rate mortgages. There is fixed rate second mortgages, but typically a line of credit is tied to the prime rate. Now, prime rate is, it trends with the Fed funds rate. It's usually about 3 points higher than the Fed funds rate. So as of today, prime rate is at 8.5%. So the way a HELOC works is you're going to take a line of credit, so you don't need to withdraw all the funds. That's one of the benefits of it. You can set it up. You can put a $50,000 home equity line of credit and not take any of it, just like a credit card. It's there if you need it type of a situation. And that's one circumstance where you might consider a home equity line of credit, is simply as a backup, as a reserve. I've talked about this before as well. The most difficult time to tap into your home equity is when you actually need it. So sometimes being prepared is a good idea. But the cool thing is you don't have to withdraw any funds from it right away. It is tied to prime rate. So there's good and bad with that, because if the feds continue to raise interest rates, which I'll tell you, it does not look like they're going to. They had an opportunity to raise rates on November 1st. They held steady for the second meeting in a row. And if you listen to Jerome Powell's commentary, I got the impression that he feels like we can probably pause on raising interest rates, at least for the foreseeable future. Time will tell. But the good news is that we don't think interest rates are going to be going up any higher as far as the Fed funds rate, which means that prime rate wouldn't go up either. And if you have an interest rate that is adjustable and it's tied to the prime rate plus a margin, I'll talk about that in just a second. But the good news is that if and when the feds lower interest rates, which they will do, it's just a matter of when they will do it. But because this is an adjustable rate mortgage and it's tied to prime rate, as the feds lower the Fed funds rate, prime rate will come down in lockstep with it. And so even though the rates are really high right now, there is a possibility that as the feds lower rates, your home equity line of credit actually sees the interest rate improve. That's one of the nice things about a home equity line of credit versus a fixed rate second mortgage. Now, we all know that things can be unpredictable. It is possible that inflation takes back off again, and we see some unforeseen things that create rapid inflation. And if that were the case, you know what the Fed's going to do. Their only tool that they have to fight inflation is to raise rates. And so look, we did see a period of time back in, the late 70s, early 80s, where rates got up to 15, 16%. Could that happen? Absolutely. I don't think it's going to happen, but it could. And if it did, and you had tapped into your home equity with a line of credit, you would be subject to that going up. Now, I think the more likely scenario is that rates will go down over time. The feds are going, the next cycle, in my opinion, is the feds cutting rates. I think that they're done raising them, but you do need to know that is a potential risk. So the good news is if they cut rates, your rate would get better. Now, how does your interest rate? Prime rate's at 8.5. So the way that the home equity line of credit works is it's typically prime rate, which is the index in this case, which is at 8.5. And then you have a margin on top of that. And I've seen margins as low as 0.24 or, basically a quarter. So prime plus a quarter would put your rate at 8.75. Not that bad for a second lien position line of credit. However, I have also seen them at prime plus 3 or even 3.5, which would put you up in that 11.5, 12% range. So it's very possible that if you're looking for a home equity line of credit, depending on your credit score, the loan to value, etc., it could be prime plus as much as 3.5, something in that neighborhood. But if you have a lot of equity in your home and you're just tapping into some of it and you have a good credit score, you very well may be able to secure something at prime plus a quarter, prime plus a half. And given where 30-year fixed rates are, that's not a bad option. So the other idea is if you don't want a home equity line of credit, you can do a fixed rate second. And it's just what it sounds like. It's a fixed interest rate. I'm seeing those in the 11 to 12% range. They are not tied to prime rate, so they're not going to go down if the feds cut rates, but they're also not going to go up if some unforeseen thing leads to higher interest rates. But they're also not a line of credit. They are typically amortized for 15, 20, maybe some at 30 years, but 15, 20-year amortization typically on one of these second mortgages. It's a fixed interest rate, and you would draw all the money out and start making payments immediately. So there's definitely a time and place for some people to do that. But in most cases, I would say, given the high rate environment we're in today, I would think the home equity line of credit's a better option because odds are rates are going to get better on that over time. Now, keep in mind, some HELOCs do have a portion of it that might be fixed. So you could fix in, some of it, and the rest of it would be variable and able to be drawn upon in the future. So just make sure that you fully understand the terms. And I would work with your preferred mortgage professional to do this. Look, a lot of banks offer and credit unions offer lines of credit, but I would start with your trusted local mortgage advisor. There's many second mortgages that are available through mortgage bankers and brokers. So talk to the person who you know and trust. And look, any good lender, if they don't have the right product for you, they're going to recommend a local bank or credit union that might have a product that better fits your needs. That's just being a good mortgage advisor. So keep that in mind. And then the last thing, which is what a lot of people are still doing, is looking at just a full-on, debt consolidation, cash out refinance. So this is where you'd refinance your whole mortgage and roll in any debt that you might have at higher interest rates. And really, this boils down to doing an analysis. There's some pretty, it's complicated, but simple for someone who has the right tools to run for you these different scenarios and help advise you on which option might be the very best one for you. So you guys, there's a little education on tapping into your equity. I've spoke about this before, but it continues to come up as a hot topic around home equity lines of credit. So I hope that information was helpful. And remember what I talked about at the beginning, what Anton said. Look, don't tap into your equity just simply to maintain your lifestyle. I would start first at looking at what can you do with your budget? What can you do to change your habits? And if you're going to tap into your equity, the very best thing to use it for is to leverage yourself into buying real estate, in my opinion. Use it to purchase an asset that's going to appreciate over time and give you some tax benefits. But also, if you have really high interest credit cards, car loans, things of that nature, if done strategically, it can be a good option to help balance your budget and keep you from getting into more financial peril. The worst thing that I could see happen is someone going into bankruptcy and or foreclosure while they have a bunch of equity tied up in their home because they didn't want to tap into it. Get the help of a trusted advisor and professional to help you figure out how to help leverage the equity you have to fix and better improve your financial situation. So hope that's helpful information, you guys. I appreciate, as always, you taking the time to watch Market Shares and share it with people. I'm getting a lot of great feedback. So as I said at the onset, some great episodes coming. Please like and subscribe to the channel, but also tell a friend, tell someone that you know about Market Shares, have them check it out. I would love you to pass on that referral. And until next time, take care.